Welcome to the Maybe Not So Great Books channel, You Decide. This is lesson 6 of 14, Graham's 7 criteria. The checklist that almost nothing passes, from The Intelligent Investor, the definitive book on value investing by Benjamin Graham, commentary by Jason Zweig.
Yeah, it's really great to be back. And today we're tackling the heavy machinery of value investing.
Benjamin Graham created the most famous stock-picking checklist in history. In 2026, almost nothing passes it. Is that the checklist's fault or the market's?
Right. And that is the multi-billion-dollar question that keeps value investors up at night. To really grasp the magnitude of what we're talking about here, we have to start with a number that, well, frankly, when I first saw it in the research packet, I thought it was a typo.
I do love a good typo, but I have a feeling this one isn't going to be funny.
No, definitely not funny, but absolutely shocking.
Yeah.
So back in 1972, when Graham published the edition of The Intelligent Investor that we are analyzing, he laid out these 7 very specific criteria for picking stocks. And he claimed that these rules would eliminate the great majority of stocks on the market.
Right, because he wanted to be selective. He wanted the best of the best. The absolute cream of the crop.
Exactly. But if you fast forward to the modern era and you take those exact same criteria...
The defensive investor checklist, right?
Right, the defensive investor checklist. If you apply that to the U.S. market today, how many stocks do you think pass?
Well, looking at the data from our source material, specifically the analysis from Portfolio 123, out of the entire United States stock market, which is thousands of companies, only 3 non-ADR stocks passed Graham's defensive criteria. Just 3.
And honestly, it gets worse. If you look at the old school value finding, where they applied all 10 of Graham's expanded criteria simultaneously, the number drops to exactly 0.
0. So effectively, we're doing a deep dive into the Defensive Investor's Bible, looking at the specific instructions in Chapter 14, and those instructions are mathematically impossible to follow in the modern market.
It feels a bit like finding a pirate's treasure map, where the first instruction is to walk past the Blockbuster video and the second is turn left at the payphone. I mean, the instructions are totally clear, but the world they describe just doesn't exist anymore.
So that really sets up the tension for this entire deep dive for you listening. We have to figure out if we are looking at a broken map. Is the defensive investor an extinct species? Or are the principles behind the checklist timeless, even if the specific numbers don't work anymore?
That is the mission. We have to see if we can salvage the philosophy from the formula. Because if the formula returns 0 and you still need to invest your money, you have to understand why it returns 0.
Okay, let's unpack this. Before we get into the 7 hurdles that apparently no stock can jump over, let's define who Graham is actually talking to here. Who is this defensive investor?
This is a crucial distinction to make early on. Graham isn't using the word defensive to mean scared or bearish. He doesn't mean the guy building a doomsday bunker in his backyard. He actually means passive. This is the investor who wants safety, yes,
Right.
But primarily they want freedom from bother. They don't want to spend their Friday nights reading 10K filings. They don't want to be refreshing stock quotes on their phone every 10 minutes. They want to avoid serious mistakes, get a decent return, and just go about their life.
Which honestly sounds like most people I know, doctors, lawyers, teachers, they want to retire, but they don't want a second full-time job managing their money.
Exactly. But Graham is very strict about this. He says, if you are going to be this type of passive investor, you cannot rely on gut feeling. You cannot rely on vibes or what your neighbor told you at a weekend barbecue. You need a quantitative margin of safety.
I really like that phrase, quantitative margin of safety. It's not a vibe, it's a calculator.
Precisely. Graham believes that safety can be explicitly measured. It's found in the balance sheet, not the corporate story. And that is where the 7 criteria come in. He uses them to build a literal fortress around the defensive investor.
All right, let's run the gauntlet. We're going to go through the 7 criteria. And I want to understand not just what they are, but why they exist, and ultimately why they are failing today. So criterion number 1 is adequate size.
Right, Graham starts with the simplest filter of all. Is the company big enough to matter?
The rule he sets down is pretty specific. Not less than $100 million in annual sales for an industrial company.
Now you have to remember, in 1972, $100 million was a lot of money. It signaled a major established corporation.
Today, though, $100 million in sales is practically a microcap in the modern S&P 500.
It really is. Even if you adjusted for inflation, that number would be roughly $600 to $700 million today, which is still tiny. But the principle here isn't really about the specific dollar amount, it's about volatility.
Why does size equal safety for Graham?
He believes that small companies are inherently fragile. They get pushed around by the broader market. They can be completely wiped out by a single bad year or just the loss of one major client. A giant like General Electric in his day could take a massive hit and just keep moving. He wants the defensive investor to own important companies.
So rule 1 is basically don't buy tiny fragile things. Seems completely reasonable.
Very reasonable. Most everyday investors naturally gravitate toward large caps anyway. But then we hit criterion number 2, and the difficulty level ramps up immediately.
Criterion 2 is sufficiently strong financial condition.
This is all about solvency. Simply put, can the company pay its bills?
So the rule here is a current ratio of 2 to 1, meaning the company's current assets must be double its current liabilities. And on top of that, long-term debt should not exceed working capital.
Here is where it gets really interesting, because Graham is effectively asking for what accountants call an acid test. He is demanding that a company be so liquid, so flush with cash and inventory, that it could pay off all its short-term debts twice over and still be standing there fine.
That sounds incredibly safe. But looking at modern companies, I feel like Apple or Walmart might actually struggle with that.
You hit the nail on the head. Modern corporate finance has changed completely since 1972. Today, companies run incredibly lean. They don't want cash just sitting around doing nothing. They want just-in-time inventory.
Right, it's all about capital efficiency now.
Exactly. A company like Apple or Walmart might have a current ratio lower than 2 to 1. Not because they are broke, but because they are so powerful they don't need to hold excess cash. They turn their inventory into cash so fast sometimes before they even have to pay their suppliers that they actually operate with negative working capital cycles.
So Graham viewed debt and low cash balances as a vulnerability, a hole in the armor. But modern finance views debt as leverage a tool to juice returns.
Precisely. If you strictly apply this 2 to 1 rule today, you aren't just filtering out risky companies. You are filtering out some of the most efficient, dominant monopolies in history simply because they don't hoard cash the way Graham wanted them to.
It's like punishing a professional race car driver for not carrying a spare tire in the passenger seat.
That is a brilliant analogy. Graham wants the spare tire, the flare gun, and a week's worth of rations in the trunk. Modern CFOs want to strip out all that weight to go as fast as possible.
Okay, so we have got size, we have got financial strength. Let's move to criterion 3 and 4, which I'll group together because they're both about consistency, earning stability, and dividend record.
Consistency is the absolute watchword here. Graham hates surprises of any kind.
The rule is the company must have some earnings for the last 10 years, so no losses allowed whatsoever. And it must have uninterrupted payments of dividends for at least 20 years.
20 years. I just want you to pause and think about that for a second.
That is a very long time. Sitting here in 2026, that goes back to 2006. That's before the iPhone even existed.
That is a full generation. It covers the 2008 financial crisis, the 2020 pandemic, massive inflation spikes, different presidents, geopolitical wars. Graham is essentially saying, I don't care how exciting your tech story is. Show me you paid your shareholders hard cash every single year for 2 decades.
This immediately makes me think of the entire modern tech sector.
It wipes it out almost entirely.
Right. I mean, Amazon, Google, Meta, none of these companies paid dividends for decades. They reinvested every single spare cent back into growth.
And Graham would say that's totally fine. Those are for the enterprising investor or the speculator. But for the defensive investor, do not touch them.
Why is he so singularly obsessed with dividends, though? Is it just about generating income for retirement?
It's about reality. You can manipulate earnings on a spreadsheet. We will talk about that with the Penn Central story a bit later. But you cannot fake a dividend check. The money is either in the shareholder's brokerage account or it isn't. It is the ultimate unforgeable proof of profitability.
Graham demands that you get paid while you wait. He doesn't trust future growth promises. He only trusts the check in the mail today.
Exactly.
Which brings us to criterion 5, which is earnings growth. Because he does want some growth, right? He isn't looking for a stagnant pond.
True, he does. But look at the bar he sets here. It is shockingly low.
The rule is a minimum increase of at least 1/3 in per-share earnings over the past 10 years.
1/3 over 10 years. If you did the math on that compounding, that works out to about 2.9% annually.
That is not exactly a rocket ship. That is barely keeping up with average historical inflation.
No, Graham isn't looking for the next NVIDIA. He is looking for a company that is fundamentally not dying. He wants to see that the business is at least marching forward, even if it's a very slow march. If a company can't grow earnings by roughly 3% a year, it is slowly being eaten alive by inflation.
So far, if we look at the profile we are building, we have a big, safe, cash-rich, dividend-paying tortoise.
A perfect description of the ideal Graham company.
But now we get to the final gates, the ones that really violently break the modern market. Criterion 6 and 7, which are the valuation filters.
This is where the rubber meets the road for value investing, because it's not enough to just identify a good company. You have to buy it at a good price.
So the rule for Criterion 6 is a moderate PE ratio. The current price should be no more than 15 times the average earnings of the past 3 years.
And Criterion 7 is a moderate ratio of price to assets. The current price should be no more than 1.5 times the book value.
And Graham actually gives us a little cheat code here. He says if one of those metrics is a little high, the other can be a little low to compensate. Specifically, the PE multiplied by the price to book should not exceed 22.5.
That number 22.5 is legendary in value investing circles. It is universally known as the Graham number.
The Graham number. It sounds like a secret code to unlock the market.
It is, but it's the specific mathematical filter that breaks the modern market. Because think about it, a PE of 15. Over the last decade of the S&P 500, the average PE has routinely been 20, 25, sometimes even over 30.
And a price to book of 1.5? I mean, I looked this up before we started. Some major tech companies trade at 10, 20, sometimes 50 times their book value.
Exactly. If you strictly follow the Graham number today, you are basically saying the entire U.S. stock market has been drastically overpriced for 30 years straight.
So if you follow his map perfectly, you just sit in cash for 3 decades.
Which is a disaster in itself because inflation completely eats your cash over 30 years.
And that leads us back to the core problem we started with. Why exactly zero stocks pass? But before we get to why the market broke these specific rules, I want to talk about why Graham made them in the first place. Because he wasn't just making this stuff up to be overly difficult. He had deep scars.
He absolutely did. Graham's rules are written in ink, but they were learned in blood, or at least in massive lost fortunes during the Great Depression.
Let's look at the stories from the source material. The deep why behind the rules. Story number 1 is Penn Central.
This is a classic cautionary tale. Penn Central Railroad. In the late 1960s, this wasn't just a normal company, it was an absolute institution. It was a giant, think of it like a massive, irreplaceable utility company today. You just assumed it would always be there.
Chapter 17 of the book goes into this in great detail.
Yeah.
In 1968, the stock was trading at 86.5. Wall Street absolutely loved it. It was universally considered a blue chip stock. 2 years later, in 1970, it went completely bankrupt.
It was the largest bankruptcy in U.S. history at the time. It shocked everyone. Every day, people lost their entire life savings. Major pensions were wiped out overnight.
But not Graham.
Not Graham. And not anyone who actually followed his defensive criteria.
Because when you looked under the hood,
It was a complete disaster waiting to happen. Graham points out that the interest coverage, which is basically how easily they can pay the interest on their massive debt, was only 1.98 times. Graham demanded a minimum of 5 times coverage for a railroad.
so they were basically drowning in debt and barely keeping their head above water.
And here's the specific detail I love. This is the real financial detective work. Graham noticed they had paid no income taxes for 11 straight years.
Wait, isn't paying no taxes generally a good thing? Like smart corporate tax maneuvering?
Not if you are actively claiming to be highly profitable. If you tell your shareholders you made a massive profit, but you tell the IRS you didn't owe any taxes, one of those statements is almost certainly a lie. Graham saw that the earnings were fake. They were clever accounting creations, not actual cash.
So the key takeaway here for you listening is that the defensive criteria, specifically those strict financial strength rules, would have completely saved you from a total portfolio wipeout.
The simplest rules of security analysis, as Graham called them, immediately revealed the rot. You didn't need insider info, you didn't need to play golf with the CEO, you just needed to check the basic math ratios.
Okay, let's move to story number 2. This one is less about hidden rot and much more about raw public insanity. AAA Enterprises.
Oh, the mobile home franchise story. This captures the speculative mania of the late 60s in a perfect nutshell.
So we have this college student. He starts selling franchises for mobile homes, not even building the homes themselves, just selling the idea of them, basically. The company IPOs at $13 a share. It quickly doubles to $28.
And what were the actual underlying earnings?
Basically non-existent.
At its absolute peak, AAA Enterprises was trading at 115 times earnings.
115 times. That sounds exactly like a meme stock or a crypto coin in 2021.
Now remember, Graham's firm valuation rule, criterion 6, PE must be less than 15.
So the defensive investor looks at AAA Enterprises trading at 115 and just says hard pass.
Immediately, Graham has this incredibly scathing line about it in the text. He says the speculative public is incorrigible. In financial terms, it cannot count beyond 3.
Ouch. That is quite a burn for Wall Street.
Meaning the public sees the stock price going up day 1, day 2, day 3, and they just buy blindly. They don't do the underlying math. AAA Enterprises went totally bankrupt within 2 years.
This again, the checklist works perfectly here. It acts as a hard emotional ceiling that prevents you from buying into pure hype.
It protects you from your own FOMO. It really is a financial straitjacket for your emotions.
But there is an important contrast we need to make here. We have been focusing heavily on the defensive criteria, but Graham also had a strategy for the enterprising investor, the highly active one. And that brings us to story number 3, which is Burton-Dixie.
Right. This introduces the net-net strategy. And this is vital to understand because it shows just how drastically different the stock market was back then compared to our market today.
So explain a net-net for us briefly. This is essentially the ultimate bargain bin strategy, right?
It is the absolute extreme of bargain hunting. You take a company's current assets, so that's its cash, inventory, and accounts receivable. You subtract all of its liabilities, every single penny of debt. And this is the crazy part. You treat the physical factories, the brand name, the heavy machines, the real estate, as if they are worth exactly 0.
0. Just completely write off the physical infrastructure.
0. If the stock price is still lower than that leftover liquid number, you buy it. You are functionally buying a dollar bill for 50 cents.
And this company, Burton-Dixie, was one of these rare setups.
Yes. The stock was trading at $20 a share. The net current assets per share were $30.
So you buy it at 20, you could theoretically liquidate the entire company tomorrow for 30 in cash, and you get all the working factories for free.
Exactly. And sure enough, the market eventually corrected itself, and within 3.5 years, the stock went to nearly 54, a 169% gain for doing almost nothing.
Graham explicitly calls this ridiculously simple.
And it was. Back in the 1930s, 40s, and even deep into the 60s, these absurd opportunities were everywhere. You could literally just trip over free money on the sidewalk if you knew how to read a balance sheet.
But, and here is the major pivot for our deep dive. Try finding a Burton-Dixie today.
Good luck with that. As we mentioned right at the top, finding a stock that passes even the basic defensive criteria is nearly impossible. Finding a true net-net in the US market today. It is basically hunting for mythical unicorns.
Because most net-nets today are just terrible penny stocks, right? Outright frauds or biotech companies burning through cash with no product.
Yes, exactly. The ridiculously simple strategy has been completely arbitraged away. The sophisticated hedge funds and their algorithms found them all decades ago.
So this raises an immensely important question for you, the listener, today. Why? Why does nothing pass the price-to-book filter anymore? Why are there no more Burton-Dixies lying around? Did the actual companies get fundamentally worse, or did the entire world just change?
This is where we have to look at the massive macro shift in the economy itself, the transition into the intangible economy.
We have some fascinating research here from Baruch Lev and Anup Srivastava in the deep dive packet.
They are brilliant accounting researchers, and they clearly point out a fundamental structural flaw in using Graham's price-to-book rule today.
Which is the PB must be less than 1.5.
Right. Think about a standard industrial company in 1972, U.S. Steel, or Penn Central. Their core value was housed in physical things you could walk up to and kick. Trains, massive blast furnaces, acres of land. Those are tangible assets. They clearly show up on the balance sheet under assets.
So the book value accurately equals the real cost of the stuff they own.
Correct. But now think about Microsoft, or Google, or even a major pharmaceutical company like Pfizer in 2026. Where is their actual value derived from?
It's all in the code. The drug patents, the global brand recognition, the massive network effect.
It's actually intangibles. Now here is the crucial accounting trick, or rather the strict accounting rule that completely ruins Graham's checklist. Under GAAP accounting rules, if you build a physical factory that is recorded as an asset, it directly adds to your book value.
Okay, that makes sense.
But if you spend $1 billion developing a revolutionary piece of software or doing deep R&D for a cure for a disease that is treated as an immediate operating expense, it is written off the books in the same year. It does not show up in book value.
Wait, so you're telling me Microsoft's most valuable assets, like Windows Office Azure, their entire intellectual property portfolio doesn't fully show up in their book value?
It barely shows up at all compared to its true economic worth. This aggressively and artificially lowers the stated book value of modern companies.
And since book value is the denominator in the price-to-book ratio?
An artificially low denominator sends the resulting ratio sky high, which means the price-to-book ratio looks absolutely astronomical on paper.
So Microsoft looks absurdly expensive, according to Graham's calculator, not because it's actually overpriced in reality, but because outdated accounting rules hide its true value.
Precisely. If you strictly follow Graham's PB rule today, you automatically exclude all major tech companies, all cutting-edge pharma, all the modern service leaders.
So who is even left to buy?
Dying regional banks, heavily indebted fossil fuel companies sitting on old depreciating equipment. You are basically left with a portfolio of value traps. Companies that look cheap mathematically because they are actually going obsolete in the real world.
So relying on a literal 1972 checklist in 2026 is actually dangerous to your wealth. You are filtering out all the best companies and intentionally filtering in the dinosaurs.
It's a classic case of the map no longer matching the territory. The checklist was brilliantly built for an industrial world, but we live in a completely digital one.
So if nothing passes the checklist, and if the easy net-nets are all gone, what does the defensive investor actually do in 2026? Just throw their hands up and give up.
Graham actually solved this problem himself, but he didn't solve it in Chapter 14 with the checklist. He solved it earlier in Chapter 9, and Jason Zweig highlights this heavily in his modern commentary.
The index fund.
The low-cost index fund.
But wait, hold on. Graham was the ultimate stock picker. He is literally the father of security analysis. Was he really secretly a boglehead?
By the end of his long life, yes, he absolutely was. Think about the mechanics of it. What does a total market index fund actually do? Does it meet the size criteria?
Yes, obviously it owns the biggest, most dominant companies in the world.
Does it meet the financial strength criteria?
Well, on an aggregate average, yes. It owns the weak companies too, but the financially strong mega caps heavily dominate the weighting.
And most importantly, it gives you the ultimate form of diversification. You don't ever need to worry about one single company failing the 20-year dividend test and wiping you out because you literally own the entire market.
So the prevailing argument is that the modern 2026 equivalent of Graham's 7 criteria isn't a complex stock screen at all. It is just buying the S&P 500 or a total market index fund.
Exactly. It passes the true spirit of the defensive test perfectly. It requires minimal daily effort. It avoids the catastrophic mistake of blowing up your portfolio on one bad stock, and it mathematically guarantees you capture the market's return.
Graham's defensive investor today is just a passive boglehead. That is incredibly ironic given his legacy.
It is the ultimate historical irony, but honestly, it gets even more shocking. Because Graham didn't just subtly hint at this evolution, he explicitly publicly said it.
This is the part of the deep dive where we have to address the massive elephant in the room, the dirty secret of 1976.
If we are going to connect this specific lesson to the bigger picture of investing, we have to closely look at what happened just months before Graham died.
He gave a very famous interview to the Financial Analyst's Journal.
Now you have to remember the context. This is the man who literally wrote the textbook Security Analysis. The man who spent his entire professional life teaching generations of people how to manually pick undervalued stocks. He is the high priest of this entire religion.
And in this interview, he says, and I'm quoting directly here, "I am no longer an advocate of elaborate techniques of security analysis in order to find superior value opportunities."
Boom. The mic drop of the century.
He just quit. He completely walked away from his own life's work.
He essentially admitted that the broader market had finally become too deeply efficient. He explicitly said, "I doubt whether in most cases such extensive efforts will generate sufficiently superior selections to justify their cost."
That is honestly heartbreaking to read.
Yeah.
It's like the Pope stepping out onto the balcony and saying, you know what, prayer probably doesn't actually work anymore.
It was a massive intellectual repudiation. He stopped using the 7 criteria. He stopped manually hunting for net-nets. He basically looked at the modern landscape and said, the game has just gotten too hard. Just buy the whole market.
And the long-term data absolutely backs him up on that right. We have this academic concept of the value premium, the historical idea that systematically buying cheap stocks beats buying expensive growth stocks.
Right. Eugene Fama and Kenneth French, the famous Nobel-winning economists, they heavily documented this. From 1963 to 1991, the historical value premium was huge. It was about 4.3% per year in outperformance.
That is the Graham edge in numbers.
But if you look at the data from 1991 to 2019, that premium shrank to just 0.6%.
It basically disappeared into statistical noise.
The supercomputers took over, the massive quantitative hedge funds took over, the edge was completely arbitraged away. Everyone in the world finally learned Graham's magic trick, so the trick simply stopped working.
So, aggressively following the Chapter 14 checklist, literally in 2026, isn't really investing. It's more like historical reenactment.
It's financial pause play. You are dressing up as Ben Graham from 1972, but the world you are walking through has completely fundamentally changed.
So what does this all mean for you listening right now? Is the checklist entirely useless? Should we just rip Chapter 14 out of the book and burn it?
No, definitely not. And this is where the debate gets really nuanced and fascinating, because there are two distinct ways to look at this problem today.
Okay, let's lay them out. Let's give the listener both sides.
Side A is the strict purist argument. This is the hardcore Graham perspective.
Which argues what exactly?
The checklist protects you from overpaying under any circumstances, period. Yes, even if following it means you completely miss out on Apple, even if you miss out on Amazon's massive run, you also, by default, miss WeWork. You miss Enron. You miss all the catastrophic high-flying disasters.
It is a ruthless filter for pure survival.
Right. And the purist would confidently say, if no stocks pass the checklist today, that doesn't mean the checklist is broken. It means the entire market is broken.
Oh, that is a spicy take. So if nothing passes, it means everything is dangerously overvalued.
Exactly. They view it as a glaring red signal to hold cash, to wait, to be highly patient. They would argue that we are currently living in a massive historical bubble, and when it inevitably pops and valuations crash, the checklist will work perfectly again.
Okay, that is side A. Stay rigidly disciplined even if it means buying nothing for years. What is side B?
Side B is the modernist argument. This is heavily championed by Warren Buffett and his late partner Charlie Munger.
The famous shift away from the cigar butt strategy.
Buffett started out as the ultimate strict Graham disciple. He only bought the dirt cheap, mathematically ugly companies, but Charlie Munger slowly convinced him to change his entire philosophy. Munger famously said, "It is far better to buy a wonderful business at a fair price than a fair business at a wonderful price."
So Buffett eventually abandoned the rigid PE under 15 rule. I mean, he bought Apple in a massive way.
He bought Apple at a PE much, much higher than 15. He bought Coca-Cola decades ago when it looked objectively expensive by strict Graham standards.
Because he finally realized that the actual quality of the underlying business matters exponentially more than just surface-level cheapness.
And here is the absolute kicker for this entire debate. The single piece of historical evidence that really undermines Graham's strict rules, it is the GEICO contradiction.
Oh, I absolutely love this story. It's tucked away in the postscript of the book.
Benjamin Graham's single best investment of his entire life, the one single play that made him the vast majority of his fortune, was GEICO.
Government Employees Insurance Company.
Graham put an astonishing 20 to 25% of his entire fund into GEICO.
Whoa. The cardinal rule of diversification broken immediately, right out of the gate.
Totally broken. And GEICO was a massive growth stock. It was statistically expensive. It brazenly broke almost every single one of his own carefully written defensive criteria.
So the man who literally wrote the ironclad rules of safety made his ultimate fortune by throwing them out the window.
Precisely. And to his immense credit, he openly admitted it in the postscript. He stated that the incredible profits from that one single GEICO decision far exceeded the total profits from all his other carefully screened investments combined over decades.
That is the ultimate investor's dilemma right there. If you strictly follow the checklist, you undoubtedly stay safe. You avoid the Penn Centrals of the world, but you are guaranteed to miss the GEICOs.
And conversely, if you break the checklist, you might just find a GEICO, or you might find a AAA Enterprises and go completely broke.
It really feels like we're stuck between a rock and a hard place here. The rigid checklist is too strict for modern times, but breaking it widely is undeniably risky.
So we have to find the intelligent synthesis between the two extremes.
Okay, so it is Monday morning. You are sitting there looking at your brokerage account. You know you aren't going to magically find a dominant stock with a PE of 12 and a 20-year flawless dividend streak. What do you actually do?
We have to move our thinking from the strict letter of the law to the underlying spirit of the law.
Let's give some concrete action steps. Let's actively modernize the checklist right now. How do we take these specific 1972 rules and make them highly functional for 2026.
First, you simply don't use the numbers literally. 1.5 times book value is dead. Just forget it. But you absolutely should use the conceptual categories as security dates. Before you buy any individual stock, force yourself to run it through these 7 modernized gates.
Okay, gate 1 is size.
Ask yourself, is this business actually real? Is this a highly fragile microcap that could totally disappear in a recession, or is it a structurally real business with a massive market foothold? Basically, avoid the tiny speculative stuff unless you are a deep industry expert.
Gate 2, financial condition.
Is it going broke anytime soon? You don't need a strict 2-to-1 current ratio today. But look closely at their debt load. Can they easily service the interest? If global interest rates suddenly double next year, do they immediately go bankrupt? If the answer is yes, you walk away.
Gate 3 is stability.
Has it consistently made money for a decade? Or is it merely a hype-driven story stock that has never once turned an actual profit? Graham correctly demands real proof of concept. Don't ever buy a hope and a dream with your retirement money.
Gate 4, dividends.
Does it actively pay you? Now, the 2026 modernized version of this metric has to include share buybacks. Is the company consistently returning real cash to its shareholders in some tangible way? Or are they just constantly burning cash and diluting your ownership?
Gate 5, growth.
Is it structurally growing? It definitely doesn't need to be a tech rocket ship, but is it consistently beating inflation over time? If top-line revenues are shrinking year over year, it is a melting ice cube and you should avoid it.
And finally, gate 6 and 7, the valuation checks.
Are you completely overpaying? This is admittedly the hardest one to modernize. You can't just blindly demand a PE of 15 anymore. But you can and should ask, is the current valuation historically reasonable relative to this specific company's own past?
So for example, if Microsoft usually trades at, say, 25 times earnings on average over the last decade, and suddenly today it is trading at 40 times earnings, Graham would definitively say, stop.
Exactly. It operates as a relative discipline check. It forcefully prevents you from buying in at the absolute peak of public market hysteria.
And what if you listen to all of that and you say to yourself, that still sounds like way too much work. I don't want to calculate modern debt-to-equity ratios on my weekend.
Then you are a true defensive investor in the purest original sense of the word. And Graham's ultimate advice for you is crystal clear in 2026.
Buy the index.
Buy the index. Go play with your kids. Sleep well at night. You'll mathematically outperform almost every single highly paid professional stock picker on Wall Street over the long run. And that is exactly what Benjamin Graham would look you in the eye and tell you to do today.
There is honestly something very freeing about that realization. The original map isn't actually broken. It just leads to an entirely different destination now.
The required destination is exactly the same: safety and satisfactory returns. The specific vehicle has just shifted from 30 hand-picked individual stocks to one low-cost index fund.
That feels like the absolute perfect place to land today. Benjamin Graham, the legendary father of active security analysis, organically evolving into the grandfather of passive investing.
A true wise man always knows when it's time to change his mind.
That was lesson 6 of 14 on The Intelligent Investor, the definitive book on value investing. Subscribe for the full series. If you haven't seen our debate overview of the whole book, check that out, link in the description. Thanks for being here. See you next time.